When you think of the internet, chances are Google is one of the first names that comes to mind, and for good reason. But did you know that by buying Alphabet Incorporated shares, you're not just investing in a search engine, but in a technological empire that's shaping the future of the digital world? In this video, we'll take a comprehensive look at Google, or more accurately, its parent company Alphabet Incorporated, and why its stock has become a core holding in the portfolios of long-term investors, hedge funds, and tech enthusiasts around the world. Let's begin with a bit of background. Google was founded in 1998 by Larry Page and Sergey Brin at Stanford, and within a few short years, it transformed how the world searched for information. In 2015, the company restructured to become Alphabet Incorporated, separating its main cash-generating businesses, search, YouTube, ads, from its experimental ventures like Waymo, Verily, and DeepMind. This strategic move allowed greater focus, transparency, and scalability. Today, Alphabet operates multiple segments: Google Services, Search, YouTube, Android, Chrome, Gmail, Maps, Google Cloud, and other bets that include its moonshot projects. Its product ecosystem is massive and touches nearly every digital user on Earth. YouTube alone has over 2.7 billion monthly active users, while Gmail handles over 120 billion emails per day. Android powers more than 3 billion devices globally, and Google Maps processes over 5 billion navigation requests every day. The company's influence is both wide and deep. But influence alone doesn't justify an investment. Financials do. Alphabet's revenue in 2024 exceeded $320 billion, with over $220 billion coming from advertising across Google Search, YouTube ads, and Google Network partners. Google Cloud, which once lagged behind Amazon AWS and Microsoft Azure, has now become a major revenue driver, posting $40+ billion annually with increasing profitability. Alphabet holds more than $110 billion in cash and marketable securities and carries little debt, giving it unmatched financial flexibility. It consistently reports healthy operating margins, high return on equity, and robust free cash flow, which it uses for R&D, stock buybacks, and acquisitions. Since going public in 2004 at just $85 per share, and adjusting for splits, Alphabet stock has delivered multi-thousand% returns. A major turning point came in 2022 with the 24-1 stock split, making it more accessible to retail investors. Its shares now trade under two tickers: Google, with voting rights, and Google, non-voting. The stock has since continued a steady upward trajectory, weathering economic turbulence, inflation concerns, and competitive threats. But what makes Google stock particularly attractive today? First, its diversification. Unlike many companies reliant on a single product or sector, Alphabet generates revenue from advertising, cloud services, hardware, software, subscriptions, and even AI licensing. It's not just a digital advertising company anymore. It's a full-stack tech ecosystem. Second, its deep investment in artificial intelligence, arguably the most transformative technology of this generation. Google was a pioneer in AI with its Transformer model, which now powers many of today's leading generative AI systems. In 2023, it launched Gemini, its own generative AI suite to compete with OpenAI's ChatGPT and Microsoft's Copilot, and in 2024, it expanded Gemini across Search, Docs, Gmail, and Android. This is no small update. This is an AI-driven evolution of how billions of people will use Google products daily. Alphabet has also embedded AI into Google Photos, Google Translate, and even YouTube, improving recommendations and video editing tools. Its cloud platform, Google Cloud, has become a go-to for businesses that want scalable, secure AI infrastructure. On the hardware front, Google is pushing forward with its Pixel smartphones, Pixel Watch, and Google Nest products, strengthening its presence in consumer electronics. Additionally, it's developing its own AI chips like the TPU, Tensor Processing Unit, giving it a vertical advantage. Third, Alphabet's moonshots. like Waymo for autonomous driving, Verily for health tech, and Wing for drone delivery, show the company's long-term innovation DNA. While these aren't profitable yet, they represent optionality for future disruption. But let's be real, every investment has risks. Alphabet faces intense regulatory scrutiny around the world, especially in the EU and US, where antitrust cases and data privacy regulations could impact its ad business model. There's also fierce competition from Microsoft, Amazon, Meta, Apple, and rising AI startups. Changes in consumer behavior, a slowdown in global ad spending, or a major misstep in AI deployment could hurt its stock. Additionally, despite its massive size, Alphabet has sometimes struggled with product integration and organizational complexity. Still, what sets Alphabet apart is its ability to innovate, adapt, and scale. The company's leadership under CEO Sundar Pichai has been marked by steady execution and bold investments. Its focus on AI, quantum computing, sustainability, and global expansion suggests that Alphabet isn't resting on its laurels. It's aggressively building the future. For investors, the big question is Alphabet stock a good buy right now? If you're looking for a company with strong fundamentals, a dominant market position, exposure to key growth trends like AI and cloud computing, and a track record of innovation, Alphabet is a compelling option. It may not be the fastest grower anymore, but it offers a rare combination of growth, profitability, and durability. Alphabet stock is considered a core holding in many growth and tech-focused portfolios, and it's low debt. When people hear the word Tesla, they usually think electric cars, but investors know it's far more than just a car company. In today's deep dive, we're exploring Tesla Incorporated, its explosive growth, unique business model, and whether owning Tesla shares TSLA is still a smart move in 2025 and beyond. Founded in 2003 and led by the visionary Elon Musk since 2008, Tesla has disrupted the global auto industry, turned electric vehicles into a status symbol, and built one of the most passionately followed brands in the world. But Tesla isn't just selling cars. It's a technology and energy company rolled into one. Its product ecosystem includes electric vehicles like the Model S, Model 3, Model X, and Model Y, cutting-edge energy storage solutions like Powerwall and Megapack, solar energy products including solar roofs, and a growing suite of software features like full self-driving, FSD, and autopilot. Tesla's gigafactories across the US, Germany, China, and now Mexico have scaled global production rapidly, and the company is aiming to produce over 2 million vehicles annually. But the real magic of Tesla is its vertical integration. It builds its own batteries, develops its own AI chips, manages software and hardware in-house, and even operates its own charging network, the Tesla Superchargers, which are now open to other EV brands. Financially, Tesla has become a powerhouse. In 2024, the company reported over $110 billion in revenue and over $10 billion in net income, with healthy gross margins despite price cuts and economic volatility. It has over $25 billion in cash, manageable debt levels, and one of the strongest balance sheets in the auto sector. Tesla's profitability is supported not only by car sales, but also by its software margins, where services like FSD, which costs over $12,000 per license, offer huge upside. Tesla's stock has had a wild ride, from under $20 pre-split to over $1,200 at its peak before undergoing a 5-for-1 split in 2020 and a 3-for-1 split in 2022. Volatility is the norm, but long-term holders have seen astronomical returns. So what makes Tesla stock unique? First, it's the vision. Elon Musk's goal isn't just to sell cars. It's to accelerate the world's transition to sustainable energy. This includes autonomous driving robot Axis, grid-scale energy storage, and even AI robotics like the Tesla Optimus humanoid robot, which is now in prototype testing. Tesla is also building Dojo, its in-house AI training supercomputer, designed to process video data from millions of Tesla vehicles to improve FSD. Second, Tesla's innovation pace is unmatched. Whether it's launching the long-awaited Cybertruck, developing the 4,680 battery cells for improved range and cost efficiency, or introducing advanced manufacturing techniques like the Gigapress, Tesla is reinventing how cars are made and used. Its AI and robotics divisions could become major revenue streams in the future, possibly even outgrowing the vehicle segment. Tesla Energy, while currently a smaller piece of the puzzle, is rapidly scaling, especially with utility companies adopting megapacks to stabilize power grids. Third, brand loyalty. Tesla has one of the highest customer satisfaction and retention rates in the automotive industry, driven by over-the-air software updates, minimal maintenance, and a clean, modern design philosophy. And now, with the supercharger network expanding and strategic deals with Ford, GM, and others, Tesla's infrastructure may become an industry standard. But let's not ignore the risks. Tesla's stock is extremely volatile and heavily influenced by Elon Musk's actions, public perception, and broader tech sentiment. There's fierce competition from legacy automakers like Ford, GM, BMW, and emerging EV giants like BYD and Rivian. Tesla's full self-driving software has yet to reach full autonomy, and regulatory concerns persist around safety, privacy, and AI. Moreover, as growth slows in mature markets, Tesla must expand into lower-cost vehicles, possibly compressing margins. And while Musk's bold vision is inspiring, it can also be unpredictable. His involvement with X, formerly Twitter, and other ventures sometimes draws investor concern. Still, the upside is massive. Tesla isn't just in the EV race, it's creating entirely new markets. If robot access become real, if Optimus matures into a useful industrial worker, or if Tesla Energy scales as expected, the company could become a leader in $3 to $5 trillion industries. Analysts project significant growth potential if Tesla executes on these fronts. So, is Tesla stock a buy? That depends on your risk appetite. For growth-oriented investors with a long-term horizon, Tesla offers exposure to EV dominance, AI innovation, and energy transformation, all under one umbrella. But expect volatility, hype cycles, and intense scrutiny along the way. Tesla is a stock you watch closely, believe in deeply, and hold patiently. If you're looking for a company that's not just part of the future, but trying to build the future, Tesla might be worth the ride. Thanks for watching this in-depth look at Tesla's shares. If you enjoyed the breakdown, please like, subscribe, and comment below. Do you own Tesla? Are you bullish or bearish on Tesla's next 10 years? Let's talk. When we think of technology giants, we often picture flashy consumer brands, but one of the most foundational companies in the tech world, responsible for decades of innovation in computing, is Intel Corporation. In today's deep dive, we're exploring Intel, its legacy, current transformation, and whether its stock presents a compelling opportunity for long-term investors. Founded in 1968 by semiconductor pioneers Gordon Moore and Robert Noyce, Intel became a cornerstone of the personal computing revolution. It developed the x86 architecture, powering nearly every PC for decades and cementing its position as the dominant chipmaker. For years, the phrase, "Intel Inside," was a symbol of computing performance. But in recent years, Intel's story has shifted from dominance to disruption, and now to redemption. Once the undisputed leader in CPUs, Intel has faced stiff competition from AMD, NVIDIA, Apple Silicon, and rising Asian foundries like TSMC and Samsung. The company lost its technological edge in manufacturing, missing deadlines for 10 nanometers and 7 nanometers process nodes, which caused delays, market share erosion, and investor frustration. Meanwhile, rivals surged ahead. AMD's Ryzen and EPYC chips outperformed Intel in both desktop and server markets. NVIDIA dominated GPUs and AI acceleration, and Apple began producing its own ARM-based M-series chips, dropping Intel from its Mac lineup entirely. But here's where things get interesting. Under the leadership of CEO Pat Gelsinger, who returned to Intel in 2021, the company has launched a bold turnaround strategy. Gelsinger's vision is clear: restore Intel's process leadership, regain data center market share, expand foundry services, and become a powerhouse in artificial intelligence and high-performance computing. The key pillar of this strategy is Intel's IDM 2.0 model, which combines in-house chip manufacturing with third-party foundry outsourcing. Intel is investing over $100 billion in new fabrication facilities, including massive chip plants in Arizona, Ohio, Germany, and Israel. These fabs aren't just for Intel's own chips. They're part of Intel Foundry, a new business unit that aims to compete directly with TSMC by manufacturing chips for other companies, including government and defense clients. This move has been endorsed by the U.S. government, with Intel receiving billions in CHIPS Act funding to support domestic semiconductor production. On the product side, Intel continues to lead in PC CPUs with its 13th and 14th Gen core processors, while also pushing forward with Xeon processors for data centers, Habana Labs chips for AI workloads, and Arc GPUs to enter the graphics market. In 2024, Intel launched its Meteor Lake processors on the Intel 4 process node, marking its return to advanced node manufacturing, and plans to hit 5 process nodes in 4 years, including Intel 3, 20A, and 18A. Each designed to leapfrog current industry standards, with ribbon FET transistors and power via technologies. Financially, Intel has been in a rebuilding phase. In 2024, the company generated over $55 billion in revenue, down from its 2021 peak, but is now showing signs of stabilization and recovery. Margins have compressed due to aggressive investment in manufacturing and R&D, but Intel remains profitable and cash flow positive. It holds over $20 billion in cash and has a solid dividend history, making it a more income-friendly stock than many high-growth peers. And despite setbacks, Intel still ships millions of chips annually and has a massive global footprint across computing, embedded systems, automotive, networking, and more. Speaking of automotive, Intel is also expanding in that domain through its subsidiary Mobileye, which went public in 2022 and specializes in advanced driver assistance systems, ADAS. Mobileye has partnerships with dozens of global automakers and is developing technologies for autonomous vehicles, making it a valuable asset in Intel's portfolio. Intel is also targeting AI acceleration with Gaudi chips via Habana Labs, competing directly with NVIDIA and AMD in the training and inference markets. With the rise of AI workloads, from LLMs like ChatGPT to data center expansion, Intel sees enormous potential in AI chips tailored for cost efficiency and scale. The company is partnering with companies like Microsoft and Meta to provide alternative silicon beyond GPUs, which are in short supply. And now, let's talk about the stock itself, Intel. Intel shares have been volatile over the past 5 years, reflecting the company's transition and cyclical nature of the semiconductor industry. After peaking in 2021, the stock dropped significantly due to earnings pressure and competitive weakness, but has since begun recovering as the market sees progress in its roadmap execution. Compared to NVIDIA or AMD, Intel trades at a much lower valuation, with a more generous dividend yield, often viewed as a value stock within a high-growth industry. So, should you invest in Intel? That depends on your investment style. If you're looking for a high-risk, high-reward growth stock that dominates in GPUs and AI, NVIDIA might be your pick. But if you believe in turnaround plays, want exposure to long-term semiconductor demand, appreciate solid dividends, and trust in Gelsinger's aggressive roadmap, Intel becomes a compelling option. It's not without risk. Execution delays, margin pressure, geopolitical tensions, and rapid innovation from competitors all remain challenges. But Intel's strategic location in the U.S., its government-backed foundry ambitions, and its aggressive push back into leadership suggest that Intel is not done yet. In fact, it may be gearing up for one of the most important comebacks in tech history. For patient investors who can tolerate short-term noise in exchange for long-term positioning, Intel offers an interesting blend of recovery, relevance, and reinvention. Thanks for sticking around for this deep analysis of Intel Corporation. If you enjoyed this breakdown, be sure to like the video, subscribe to the channel for more insights on investing and technology, and let us know in the comments. Do you believe in Intel's comeback? Are you buying, holding, or staying away from Intel? Let's discuss. When people hear Walmart, they often think of a giant store with low prices and big crowds. But behind the brand is one of the most powerful, resilient, and transformative companies in global retail history. Today, we're doing a deep dive into Walmart Incorporated, exploring whether its stock, trading under the symbol Walmart, is still a smart long-term investment in 2025 and beyond. Walmart was founded in 1962 by Sam Walton with a single goal: offer everyday low prices and exceptional customer value. That principle not only revolutionized American retail but also built a business empire that now includes over 10,500 stores in 19 countries, a workforce of more than 2.1 million associates, and annual revenues exceeding $640 billion. For decades, Walmart dominated traditional brick-and-mortar retail through a combination of scale, logistics, and relentless cost efficiency. But in recent years, especially post-2020, Walmart has transformed into a tech-enabled, omnichannel powerhouse. Competing not just with Target and Costco, but directly with Amazon, Shopify, and even fintech platforms. Walmart's evolution has been driven by strategic investments in e-commerce, automation, AI, and supply chain innovation. It now offers online grocery pickup and delivery in thousands of locations, same-day shipping on millions of items, and a rapidly growing subscription service called Walmart Plus, which rivals Amazon Prime by bundling free delivery, gas discounts, and access to streaming via Paramount Plus. Walmart's marketplace has expanded rapidly, attracting third-party sellers, and its ad business, Walmart Connect, is growing fast, leveraging its massive customer data to drive targeted retail media campaigns. Financially, Walmart remains a juggernaut. In 2024, the company posted over $640 billion in revenue, making it the largest company by revenue in the world. Its operating income was around $25 billion, with steady earnings growth despite inflationary pressures and tight labor markets. Walmart's diversified revenue streams, ranging from groceries, which make up over 50% of U.S. sales, to apparel, electronics, pharmacy, and even financial services, give it an unmatched level of stability, even during economic downturns. It also operates Sam's Club, a fast-growing warehouse model with over 600 locations, and is expanding globally with a strong presence in Mexico, Chile, China, and most notably, India, where its majority stake in Flipkart gives it access to one of the world's fastest-growing e-commerce markets. Walmart's strength isn't just in size, but in operational excellence. Its global supply chain is powered by a mix of centralized logistics, smart inventory management, and now, increasingly AI-driven automation. It's investing heavily in distribution center robotics, autonomous delivery, drone experimentation, and generative AI for customer service and analytics. At the same time, Walmart is becoming a major player in fintech, through Walmart GoBank, partnerships with Ribbit Capital, and efforts to launch a digital wallet and financial services for underbanked Americans. On the ESG front, Walmart is working aggressively towards sustainability, committing to 100% renewable energy, zero waste in operations, and a zero-emissions vehicle fleet by 2040. For income investors, Walmart is also one of the most consistent dividend payers on Wall Street. It has paid, and increased, its dividend every year for over 50 years, making it a dividend aristocrat. As of 2025, its dividend yield sits around 1.4%, modest, but extremely reliable, backed by strong free cash flow and prudent capital allocation. While its stock price doesn't see the explosive jumps of a tech startup, Walmart offers steady, compound growth. Its share buyback program is ongoing, and its capital discipline helps ensure shareholders are rewarded even as the company aggressively reinvests for long-term growth. Now, what about the risks? Walmart operates in a fiercely competitive environment. Amazon remains a formidable rival in e-commerce, and rising labor costs, supply chain disruption, and inflation have tested margins. Regulatory scrutiny, especially around labor practices, wages, and antitrust issues, also looms. Moreover, Walmart must continually navigate shifting consumer preferences, technological disruption, and geopolitical uncertainties in international markets. However, the company's scale, adaptability, and core mission of affordability give it powerful levers to maintain leadership. Its investments in AI, digital infrastructure, private label expansion, and supply chain resilience suggest it's not resting on its past. In fact, Walmart is uniquely positioned at the intersection of physical and digital commerce. So, is Walmart stock a buy? For long-term investors seeking stability, strong cash flow, exposure to global consumer spending, and consistent dividends, Walmart is a solid blue-chip holding. It may not have the flash of a high-growth tech firm, but its disciplined execution, digital reinvention, and economic moat make it one of the most durable and strategically important companies in the market. If you're looking for a company that thrives in both booms and busts, balances innovation with operational efficiency, and keeps evolving with customer behavior, Walmart deserves a close look. Thanks for sticking with us for this in-depth analysis of Walmart shares. If you found it helpful, give the video a like, subscribe for more insights into top stocks, and drop a comment below. Do you own Walmart? How do you feel about its digital transformation and global strategy? Let's discuss. Intel Corporation, ticker symbol Intel, is one of the most iconic and influential companies in the history of computing, but its story is no longer just about microprocessors. It's about disruption, reinvention, and the future of the global tech industry. Founded in 1968 by semiconductor legends Gordon Moore and Robert Noyce, Intel became a foundational pillar of the digital age, creating the x86 architecture that powered generations of personal computers and servers. For decades, it was the undisputed king of CPUs, driving innovation in PCs, laptops, and data centers while building a trusted brand through its famous Intel Inside campaign. But fast forward to the 2020s, and Intel finds itself at a critical crossroads. Once an innovation leader, it fell behind rivals like AMD and TSMC due to delays in advancing its chip manufacturing process, most notably struggling with its 10 nanometers and 7 nanometers roadmaps, which allowed competitors to gain market share and technological leadership. Apple moved away from Intel chips in favor of its own ARM-based silicon. AMD surged with Ryzen and EPYC processors, and NVIDIA dominated in AI and GPU acceleration. However, under CEO Pat Gelsinger, who returned to Intel in 2021 with deep engineering experience and a bold vision, the company has launched an aggressive turnaround plan called IDM 2.0, which stands for Integrated Device Manufacturing. The strategy involves a hybrid approach, building Intel's own chips while expanding its foundry business to manufacture chips for other companies. Intel is investing over $100 billion into new chip plants across Arizona, Ohio, Germany, and Israel, aiming to rival TSMC and Samsung as a go-to manufacturer for advanced semiconductors. Intel's ambition is not just to regain leadership in chips, but to become a national security asset for the US and Europe, reducing dependence on East Asian fabs in a geopolitically unstable world. This vision has earned Intel substantial funding from the U.S. CHIPS Act and the European CHIPS Act, with billions in subsidies supporting domestic semiconductor capacity. On the product front, Intel continues to lead in PC and server CPUs with its Core and Xeon lines, but it's also entering new frontiers. AI chips through its Gaudi processors from Habana Labs, discrete GPUs under the Intel Arc brand, and advanced system-on-chip platforms like Meteor Lake and Lunar Lake. It's developing next-gen process nodes such as Intel 4, Intel 3, and 18A, which feature breakthrough technologies like ribbon FET and Power VIA to compete with the industry's most advanced nodes. In 2024, Intel began ramping up AI workloads across its client, data center, and edge platforms, positioning itself as a cost-efficient alternative to NVIDIA's dominant but expensive GPUs. Financially, Intel has been under pressure in recent years due to margin compression, lower PC demand post-pandemic, and high capex tied to its manufacturing expansion. In 2024, Intel generated around $55 billion in revenue, down from earlier highs, but the company has remained profitable and free cash flow positive, maintaining a strong balance sheet with over $20 billion in cash. Intel's dividend yield, currently around 1.6%, is attractive for value and income investors, and while the company paused dividend growth during the peak of its transformation costs, it remains committed to shareholder returns over the long term. One of Intel's crown jewels is Mobileye, its autonomous driving subsidiary, which IPO'd in 2022 and continues to partner with major automakers around the world in deploying advanced driver assistance systems. Mobileye is a strategic asset that gives Intel exposure to the high-growth autonomous vehicle market, while also reinforcing its reputation in embedded computing and edge AI. Another promising division is Intel Foundry Services, which has already begun securing external customers such as MediaTek and government agencies, potentially creating an entirely new revenue stream independent of Intel's traditional product business. But of course, there are risks. Intel faces intense competition not just from AMD and NVIDIA but also from Apple Silicon, ARM-based architectures, and hyperscale cloud providers designing their own chips. Manufacturing execution is still under the microscope, and any slip in hitting roadmap milestones could spook investors. The company is also navigating global supply chain constraints, rising material costs, and complex geopolitics, especially with the U.S. China tech conflict. Still, Intel's deep IP portfolio, vast R&D infrastructure, massive global presence, and renewed leadership give it a unique shot at a historic comeback. The big question for investors: is Intel a turnaround play or a value trap? That depends on your time horizon and risk tolerance. For those who believe in the long-term semiconductor supercycle, with AI, edge computing, data centers, autonomous systems, and advanced manufacturing as core growth drivers, Intel offers a compelling opportunity to invest in a company that's not only transforming itself, but also reshaping the future of global compute infrastructure. Trading at a significantly lower valuation than peers, like NVIDIA and AMD, Intel may offer more upside potential if its turnaround succeeds. And with strong government support, mission-critical products, and a renewed focus on engineering excellence, the pieces are falling into place. In the end, Intel isn't just trying to win back market share, it's trying to win back the narrative. It wants to go from being the underdog of the 2020s to the architect of 2030's AI, compute, and chip sovereignty landscape. If that vision becomes reality, those buying Intel shares today could be investing not just in a company, but in a national and technological comeback story. Thanks for watching this in-depth breakdown of Intel Corporation. If you found value in this analysis, hit that like button, subscribe to the channel for more deep dives into top tech and investment stories, and leave a comment below. Are you bullish on Intel? Do you believe in its turnaround, or are you waiting on the sidelines? Let's have that conversation.